So we've been talking about the oil gold trade and interest rate trade, which are definitely on the table. We have a stability in gold right now, a little consolidation. Oil, the nice little sell off. Now, remember, we've been guiding certain currencies with oil being one of the influencers, Australian dollar being one of the key ones. So when we left off last week, we had come off a major high, newer move high, and we were starting to consolidate. And I mentioned that it looked like a head and shoulders formation was potentially forming. Well, we got the trigger yesterday. The Australian dollar sold off nicely. It took out the neckline as well as made a newer move low, which confirms a head and shoulder no matter what. So I got that as a downside target now of about 0.7520 around that area. Nothing major and extreme, because if we get a rally in oil, this is going to put the brakes on this break in the Australian dollar, US dollar. But right now we are starting to see that little rotation. I mean, we have had a nice sell-off in oil over the past couple days. The interest rate equation is not off the table yet. Now, I'm not trying to call a bottom in the bond market. I mean, we were talking about this a month ago. I thought that, we would be like 5 handles higher than where we are right now. I didn't think we would sell off as much as it has. So as far as that variable in currency pricing, that's still very edgy. And remember, we talked about unemployment, how that's going to become a big number to watch with the bonds over the next few months, which is also going to affect the currencies as well. So I think that we definitely need to key off of those. But because of the oil trade, and this is where I'm looking at the currencies right now, we have the head and shoulders in Australian dollar, US dollar, so short-term bear. US dollar yen is consolidating. Okay, so you would remember how oil and gold have been kind of driving the yen trade. Right now, because gold is fairly stabilizing, I think that's why you're seeing it just buffer on its highs. And remember, we have flight to quality currencies. I just want to remind your viewers, you have the US dollar, you have the Swiss, and you have the yen. Right now, the dollar is flight to quality. Bonds are falling, Swiss franc is falling, the yen is falling. Okay, so we have to stay focused on those trends in those currencies. So I think that the yen, you may see a little bit more of testing of support down to 108, 107.5. Maybe if you get let's say a rally in gold to kind of buffer up. Remember, I had an upside target around 1770, maybe 1800 tops in gold. If we can see a spike up there, you might see that little dip, again in the yen. But I don't think that's going to happen. I think that's kind of consolidating right now, and it's heavily watching oil right now, especially for the yen. Then we go to U.S. dollar Canada. After we talked last week, remember I was saying, do not try and catch a falling rock. The trend has been so bearish with the U.S. dollar Canada, especially because of oil. Because of the sell-off in oil since last Thursday, we've had a nice corrective bounce in the U.S. dollar Canada. So for any of your viewers out there that are trading that, they got to be focused on the fact that the U.S. dollar Canada has been a long-term bear against the dollar over the past year. Okay, so it's oil related right now as far as this bounce. Okay, it's already hit the corrective points as far as going back up through resistance. I don't think you're going to see very much more of a rally in that currency right now. So now for the U.S. dollar Swiss, I do have an upside target now of 94.5. They are buffering under the highs, and like I said, the flight to quality currencies in markets right now, they're all tanking except for the dollar. That's where flight to quality is right now, especially with gold stabilizing and not swinging around. There is nowhere else to go because the bond market's tanking. You know what I'm saying?
Sure.
So, and then pound US dollar, obviously testing support right now. We've been following that with the oil trade as well. I think you can see a correction down to about $1.36 even in the pound, but that's about it. We would need to have a big corrective slide in oil, I think, to really get anything below that. And you got to remember, we're post-Brexit. Even though there's lockdown measures going on in the UK and the EU, post-Brexit means that the EU is on their own now. So the UK is taking care of themselves, and I think
Sure.
they're going to still get strength because remember when the Swiss decoupled the euro about a year and a half ago when they stopped supporting the euro? Well, the Swiss is doing that right now. That's one of the reasons why the Swiss franc is weaker, because they're buying euros trying to prop up their market,
Okay.
So And we also know that as far as central bank actions, like remember I've been saying how, I'm always adamant about, there's the commodity driven parts that can happen with currencies sometimes, like right now it's being influential, but interest rates are definitely a function of currency pricing. We haven't had any central bank real action that's unexpected over the past couple months. We know that they're going to try and keep rates low, but your yield curve, even in the 10-year now, is starting to push through support as well. Initially it was just the 30-year with the short term staying locked on their highs, like the euro dollar and stuff like that, and the 1-year and 2-year notes, they're barely coming off their highs. This 10-year inflection now is kind of a big deal. I think that especially as we watch the unemployment numbers, and I know you had a thing about durable goods and stuff like that a little earlier about some of the production numbers.
Sure.
These numbers are going to be big. They're not just for the stock market. Remember, these are all bond numbers. There's about 8-9 numbers a month that come out for the bond and the interest rate markets. No one's talked about them for years because it didn't matter. You got to remember, a year and a half ago, we're at record low unemployment. Unemployment wasn't even a factor, and even a rise in unemployment by a couple percent would not have really done anything to the bond market. We're in a different scenario right now, So, and I think that we're going to start to see this, the dollar strength, there's a lot of dollar bears out there. And I think it's going to be very hard pressed to be very bearish to dollar in the short run right now. Not unless we have a huge sell off in oil. We'd have to have a big rally in the interest rates. And especially what scares me the most is the US dollar Swiss. The fact that that's buffering its highs, it's ready to break out to the upside again. There's no geopolitical or banking action to justify the Swiss being so battered by the dollar right now. So that means that long term, by your different trade zones, the lockdowns in Europe and the ramifications of what's going on with the slowdown in their economy, people are really pessimistic now on the EU, So, and I think that
it's
you're going to see that.
Quite a problem they got going on over there right now, compared to us, especially right now, yeah.
Right, and that's going to be where, we've been talking about this now, where the dollar index is going to be a hard gauge, even though right now it just is busting out, trying to make newer move highs. But remember, the euro and the pound are the two biggest components. So they're free flowing from each other right now. They're no longer a bull or a bear together versus the dollar. The pound's very oil related, but the EU, it's not the oil so much as it is the interest rates and the economy, and I think that's going to continue, that we have